Hello everyone, welcome back to Fundrise Finance. The S&P 500 chart so far this year looks like a mountain range with so many dips and spikes. There are so many unknowns in the market still. The Russia-Ukraine war is still waging on. We have inflation going higher and higher every month, and the supply chain constraints may take some more time to settle down. A long-term investor should not be bothered about this volatility and should keep investing into the market consistently, even the market is up or down, because in the long run, the market always tends to go up. It does not matter if you invest $10 a day or 100 a week or 1,000 a month. Every dollar you invest matters. It can be in your taxable brokerage accounts or the tax advantaged accounts like the IRAs or the Roth IRAs. Time in the market is what that all matters. If you're looking at situations where one expects dividends to pay their bills regularly, this disciplined investment really matters over there also. Here in this market chart that dates almost 40 years ago, we can see different situations like the dot-com bubble of the early 2000s, the market crash of the 2008, and also the coronavirus pandemic of 2020. The stock market has weathered all these situations and ended up turning on the upside. Investing journey need not be a complicated one. Let me show you one simple portfolio which I follow personally for my Roth IRA. This is a portfolio consisting of 4 ETFs with 80% of it investing in US companies and 20% internationally. The 80% US portfolio is where I spread between two ETFs, one being VTI, which is the Vanguard Total Stock Market ETF, and the other 40% in SCHD, which is the Schwab US Dividend Equity ETF. VTI lets me invest into the stock market in a fuss-free manner. It gives me access to more than 4,000 companies spread across multiple segments of the market, be it large cap, mid cap, small cap, or micro cap. It has a very less expense ratio of just 0.03%. VTI has more than 20 years of history. As we can see here, it started in 2001, and over the last 21 years, it has given almost 290% of returns. So it does have a long history that can be relied upon. SCHD, which is the Schwab US Dividend Equity ETF, takes up the remaining 40% of my US portfolio. SCHD is an extremely efficient dividend ETF. SCHD also has a very less expense ratio of just 0.06%. It has various filters in place to select the best dividend paying stocks. SCHD also has a long history of 10 plus years, and in the last 10 years it has given almost 210% of returns. Though SCHD is a dividend ETF, when we compare it against an S&P 500 ETF like WU, we can see it have been going neck and neck with the S&P 500 all the way through and giving almost similar returns, but also giving a good dividends on the side. My international composition for 20% is a copy of the US portfolio, but just an international flavor. So here we have first VXUS, which is a Vanguard Total International Stock ETF that takes up 10% of that international portfolio. VXUS is to international what VTI was for US. It gives me access to more than 7,700 companies at once at an extremely low expense ratio of just 0.08%. The remaining 10% of my international portfolio is with the SCHY, which is the Schwab International Dividend Equity ETF. This is the international version of the SCHD. It is a fairly new ETF that launched just last April, that is April of 2021. It also has a low expense ratio of just 0.14%. It has the same filters and screens that SCHD uses, but for international stocks. That gives me enough confidence to keep SCHY in my portfolio, though it is fairly new. An alternate option for SCHY in the international space would be VYMI, which is again from Vanguard, that focuses on international dividend paying companies. In this example here, what you see is $500 being split among these four ETFs, with $200 going to VTI, $200 going to SCSD, and the remaining $100 split between VXUS and SCHY. This portfolio currently gives a yield of 2.36%. This dividend is growing at a rate of 9.12%. So if I leave this investment of $500 untouched without investing a single penny anymore, at the end of 10 years, that investment would be around $937. But given we are assuming here an investment in a Roth IRA style, let's say our annual contributions are $6,000 And assuming a modest price appreciation of 8% and a dividend growth rate, let's say, of 5%. With these settings, our final portfolio value at the end of 10 years would be $95,664 with more than $2,000 as annual dividends. When we increase the time span to 25 years with the same settings of 8% appreciation and a 5% growth rate in the dividends, the portfolio at the end of 25 years, which is in 2046, it will be more than $500,000. So $572,332 and an annual income of $8,000, which is almost $700 per month. So assuming a Roth IRA style of investment where you can invest $6,000 every year, which is like $500 every month, you can see a huge increase in your portfolio value as well as your dividends earned from that portfolio. Track your dividends doesn't let us look at the data more than 25 years. So I go to this dividend calculator from MarketBeat where I can provide the same settings of 500 being my starting principal. I invest $6,000 annually. My dividend yield is 2.36. The dividend growth is 5% per year. The share price appreciation is 8% per year. I reinvest my dividends. And here I give 35 years as my investment horizon, which means my current age is in this example of 25 years and I plan to retire by 60. So that's 35 years of investment horizon. And when we calculate the dividends, here we can see year by year breakdown. So as you can see, the snowball effect in clear motion over here. So whatever dividends we earn from every year just get reinvested into the portfolio, and a modest investment of 500 at the start of your investment journey turns into a humongous value. So this is why I was saying earlier, your investments need not be a huge amount each time. They can start off slowly and gradually they can pick up over the time. Start with something as small as like $100 a month, and slowly you can increase your investments and you will be amazed to see the results down the line. So choose your investments wisely, invest regularly, and keep your investment journey simple. And if you follow these principles, the results at the end of your investment journey would be amazing. If you like this video, please click on the like and subscribe buttons so that YouTube can suggest this video to many more people. See you in the next video. And until then, let's try as much as possible to be financially healthy. Thanks. Bye.